that's Bajaj Finserv. It's just been one of those massive wealth creator. I can use massive once again because the kind of return Bajaj Finserv and Bajaj Finance have given to their shareholders, I think it's absolutely trailblazing. As Sreenivasan joins us now, CFO with Bajaj Finserv. Mr. Sreenivasan, good morning. Thank you for joining us. It's your first time, at least, on the morning show. So, very warm welcome. Thank you for joining us. Pleasure you could join us. You've seen. Can you hear me, Mr. Sreenivasan?
Yes, I can hear you.
Hi, so first time I've interacted with you and on this forum, so good to have you and welcome to the show. Could you broadly walk us through first the big picture? Big picture
thank you.
For Bajaj Finserv, big picture for the insurance industry. What kind of growth you think you see in the life insurance sector now? Right. I'm putting too many questions into one, but first if you construct the big picture for us, it will be easier for us to ask a follow-up question.
I know. Right. This quarter has been quite favorable for our general insurance business. We have grown about 23% on gross premium. In terms of life insurance, we have seen reasonable growth. Our gross premium has grown by 18%. Overall, this quarter I would say is muted, especially for life insurance, because most of the life insurance business happens in the second half, particularly in the last quarter, because that is the tax season. And Bajaj Finance, as you have seen, has grown quite strong. We see considerable demand for consumer loans. We have grown strongly in SMEs, in commercial lending, and particularly in our rural lending portfolio.
Right. Mr. Sreenivasan, general insurance profits, and I want to start by talking about that, have been strong, aided by premium growth and improvement in combined ratios. What led to strong premium growth and improved combined ratio, and are those numbers sustainable?
See, premium growth would depend on the external factors as well, particularly sales of motor cars. We are seeing good traction on our health business, both on the retail side, on the corporate side, and even on the government health schemes. There is slight muted growth in corporate lines like property, engineering, and other businesses which companies write. But generally on the retail side, we are seeing strong growth, and we as Bajaj Allianz have always been more retail focused. We are very strong in motor insurance and health insurance, so that has aided us. Whether that will be sustainable over the next 3 quarters, one has to wait and see, because this is also a business of selection, and that is why our combined ratio is one of the best in the industry, probably the best. Last year we recorded the highest profits among all private insurers. This year again the combined ratio has improved, so our expectation is that we should be probably the most profitable general insurer this year as well. Our company works with a lot of discipline in terms of underwriting. There are some businesses that you may have to forego on the top line side in order to maintain the profitability, and we have a very strong and stable management team which is really focused on executing the business with discipline.
Help us understand then that for general insurance...
This year, of course, we have seen lower claim ratios in the first quarter.
Okay, fair point. Where to your mind could be the market share growth that you're aiming for general insurance in particular, and which segments do you think a year from now could really aid that bump up?
We are seeing more growth possibly coming over the next 2 to 3 years. I can't really comment on what will happen now. Mostly on the liability side of corporates, things like cyber crime are picking up, directors and officers are picking up. They are still a small proportion of the market. On the personal lines, we see strong growth continuing in the health insurance space. The asset insurances, which are like car insurance and property insurance, that would follow the asset creation in the economy, and usually there is a lag. So once capital formation picks up and car sales pick up, after a lag you would see that they translate into growth for the general insurance industry. In general, general insurance is an industry, even in when the GDP growth was quite low, they were still growing at about 10%. In good times, they generally grow at about 18-20%. because it's still a very seriously underpenetrated market, particularly on areas like health, on liability, on various segments of the general insurance business.
You know, for a long time, we've debated whether one should follow an agency-based model or one should focus on the direct model. When I say direct model, the online model and the model of acquiring direct customers, both have their merits and both have their advantages and disadvantages. Which way are you likely to focus on? Because that is critical in the way how your cost and how your margins would be mapped in 3 to 5 years.
See, globally, if you see, agency is always a very strong component of the distribution of any insurance company, be it life or general. There are products which require explanation. In the case of life insurance, the agent is actually a sort of investment consultant as well, to the extent of investment linked products. So they would require explanation. In the case of general insurance, if people are buying health insurance, if they are insuring anything other than simple things like motor cars, they need advice. So agency will definitely continue to be the mainstay of the business. Direct channels are emerging in India. The type of products that people sell on direct are mostly standardized, commoditized type of products like term life and car insurance. As of now, the traction is not very significant, but as we go forward, we think direct as a proportion should grow. So in the long run, if you ask me, there will be 3 channels which will dominate distribution of all insurance companies. One would be agency. Second is distribution through corporate agents like banks, what is called bank assurance. And the third is an emerging direct sales. Direct sales can be either online or it can be offline through your own sales force. So in terms of cost, it is the weighted average cost, how the mix pans out. But ultimately, the customer will decide which channel they want to come to. And we both our companies are multi-channel companies. We offer all the channels of convenience for customers to come in, and they have to choose which channel they want to come to.
Let's understand the dynamics of the life insurance sector now. One is term, second is ULIP. Where do you see growth coming in? And another embedded question to that is that, are you likely to grow because of the sector growth, or are you likely to grow because of market share gain?
That's a good question. It is beyond term and ULIP, there is also an intermediate big chunk of the market. The biggest segment of the market is what called traditional savings products, which consists of participating and non-participating. They are mostly guaranteed products. Unit-linked or open-ended products, which also give direct equity exposure. So to some extent, they are comparable with mutual funds. And the third is term insurance, which again is either done through the group mode or retail direct individual sales to customers. As we go forward, as of now, the retail individual sales is a very small portion of the market. I suspect both the online and offline put together will not be more than 5% of the market. The group term life is also a profitable segment, and that is growing. They are largely done through banks. They are sold to protect the bank's interest in when they lend to customers. If something happens to the customer, the loan gets repaid. Those are big segments of the market. We do a lot of group insurance also through microfinance and regional rural banks, where we are the largest player in the private sector for a number of years now. Between ULIP and traditional, it is a function of the markets. We have seen in the past that when equity markets underperform or have a negative performance, which is fairly long, then you tend to see that people want guarantees. If the risk environment deteriorates, we find that people tend to go for traditional products. So as a company, we are looking at a sustainable product mix. This quarter, we have actually, our ULIP exposure has reduced from 78% to 61%. We have increased our traditional product mix. So the balancing would depend largely on the external factor and again on the customer segment you're targeting. Traditional products typically have a lower ticket size, so the premium growth may not seem large, but they are from a margin and profit perspective, they can be quite profitable. If you are in tier 3, tier 4 towns where we are fairly strong, and historically we have been strong in those areas, then you tend to have a greater mix of traditional business. ULIP is, it's like ice cream. There's a flavor of the month. For a few years, ULIP, equity markets are going well, everybody wants ULIP. When the market comes down, people want guarantees. So as we see, our life company did not perform well between 2012 and 15 because of product regulations and various other factors. But last 3 years we have been growing very strongly on the individual side. We think we would be, depending on both the factors, a market growth, return of financial savings into life insurance, and third, our own increase in market share.
Appreciate your time. Thank you for joining us.